My guest is nationwide tax strategist, Carlotta Thompson.
I created the pathway to zero, which is the pathway to zero taxes. And the number one most important thing, if you don't learn anything from this podcast, is to keep your documentation, keep your records.
So you work for the evil empire?
Yes, I thought I was actually going there to change the world was what I was going in for. I realized real quick that that was not my job.
Hey there, and welcome to another episode of the Jack Bosch Show, where we talk about all things real estate, finance, and entrepreneurship. And today we have a special episode where we're going to talk about taxes and tax strategies and 100 loopholes to save you taxes. And my guest is nationwide tax strategist, Carlotta Thompson. Carlotta, how are you doing today?
Great. It's nice to meet you. Thank you for letting me be on your podcast.
Wonderful. I'm excited to have you here. So let's jump right in. What do you guys do with taxes or in the tax space?
Yeah, so I created the pathway to zero, which is the pathway to zero taxes.
I like that.
It's an actual pathway that you go down as an entrepreneur or real estate investor to get to zero. And so we break that down by acquiring, first of all, having a business or having real estate. Obviously, you're already in the business space. So all your listeners probably either have enough real estate to have a real estate management company or have a business. And so that's kind of where we start. And then we implement our personal strategies, we implement business strategies, we implement real estate strategies. And then at the end, we look at acquiring an additional business or additional real estate. And so I started my journey at the IRS and I focused on real estate. So the way I got into entrepreneurship was actually through real estate. I have 42 doors, and so definitely in that space. What I found was that you can also, when you have a ton of real estate, then you can also start acquiring businesses. And so, yeah, that's what we do. We focus on helping people pay zero tax.
So you worked for the evil empire?
Yes, I thought I was actually going there to change the world and help them realize that business owners weren't doing everything that they were supposed to be doing, right? That they were overpaying taxes. So I was thought that was what I was going in for. I realized real quick that that was not my job, but I was a little, I guess, gullible. The first thing I ever got from the IRS was when I was 14, I got a booklet to tell me how to prepare a tax return. And so I thought they were more educational. I thought that they really cared and that they wanted us to pay the least tax possible because I got educational material from them. I know that's silly, but that is how I got started. So yeah, I love it.
Okay, so let's talk about that for a second before we go into what you really want to do. Now, how long did you work for the IRS?
7.5 years.
7.5 years, and you worked on the real estate side. So now, what's the?
I actually worked in the small business side of.
Okay, small business side. So
yes.
what's the atmosphere in the IRS? Are you being told like go collect as much money for the government as possible? Are you told just follow the rules as much as possible? Are you told help the like what is it like on the other side? Because I mean, to me, like I don't ever deal with the IRS, my CPA does, but I only get those things when they're kind of miscalculated or I miscalculated or they miscalculate something. And then they charge you like $7.39. Or one time I got something for like I got a 35-cent refund. And it's like, the postage costs more than that. Like, is there anyone that kind of can make a decision to say like, it's not worth sending a 35-cent refund or how is it on that side? Like, what's the culture like over there?
So I was in,
at least as far as you could tell.
Yeah, I was in SBSE. I was small business self-employed. And the IRS just wants you to do it correctly, right? But they are a company of documentation. So as long as you have the documentation, you're fine. They're not, all the tax strategies in quotations that we use are really just black and white in the code, but no one knows they exist. And the reason why no one knows they exist is because accountants are so terrified of the IRS. It's so crazy to me, but they're just so scared that they're going to do something wrong. And so instead of going and learning all these different things that their clients can do, they only do what they understand they can do. And if you don't get taught about it, or, new laws come out, you just kind of get behind. And so at the IRS, they're not like, oh, go, charge people more money. No, they're focused on making sure that you have a correct return. And what I found is the number one reason why people don't have correct returns is because they don't have the documentation to substantiate the expenses. And they have accountants that don't help in an audit. So what the accountant will do is they'll represent them, but they'll be like, oh, um, just disallow that. The client doesn't need that. Disallow that. Disallow that. And it's like, if you would just help your client come up with the documentation to take the deduction, there would not be near as many changes, because usually it's not that they've done something wrong, it's that they just don't have the substantiation. So let's
Okay.
say that's the number one most important thing. If you don't learn anything from this podcast, is to keep your documentation, keep your records, and make sure that if you are under audit, that you provide all that information.
Okay, very good. Now that's really valuable, because again, everyone thinks of that like the IRS is like, that's why I jokingly or half jokingly said like the evil empire, but I don't really mean that. I understand they have a government mandate to collect taxes, but so it's really really good to know that they're not like evilish trying to do something. They're just basically sticklers on the rules and want to make sure that you have substantiation of what you say you have done. And if you have that, so documentation is really, really key, because if you have that, then it's usually okay. So that's really good to know. So for everyone listening right now, at the very least, keep those receipts in a box, so that even if it takes you hours to find them, at least you find them.
Yeah, and I'll
Is
tell
that
you
right?
another thing on the real estate side. It's super important that you keep detailed records of your hours worked in the real estate. Like if you're going, I know you are in land flipping, or if you're in house flipping, or if you're in short-term rental, or if you're in long-term rental, keeping the records for how many hours you devote. Use something like Reps Tracker or something like that, because a lot of times your accountant's going to, use something like saying you're a real estate pro, or they're going to say you're passive or you're active or something like that. And whatever they say, you've got to have the hours to substantiate that. That is the
Okay.
most important thing in real estate.
So when they say you're passive, what do you then need to show less hours worked in real estate, because so that you can basically say I'm passive?
Well,
Or
it's really, I mean, really, the IRS is not going to be like, oh, you said you were passive, you should have been non-passive. That's usually not how it works. Usually the IRS is gonna really look at like, you say you're not you say you're non-passive, are you really?
yeah.
So that's really
You say you're a real estate
usually why.
professional. Like we
Yeah,
we
you
just
say
had
you're a real
dinner
estate
with friends.
professional.
He's a gastroenterologist. She's a dentist, but she's no longer practicing. The kids are about to get out of school, and she's like, they have rental property, they have things, and it's like one of us needs to be a real estate professional, guys,
Yeah.
and she is looking to become that, but she is obviously needing to document that really thoroughly, because the IRS probably takes, particularly if it's like the known case of like high income earning medical doctor, they're probably going to take a closer look at that. Now, I have been full time in real estate for 20 something years. I don't think anyone can claim that. Like I don't keep a log anymore. But at the same time, if somebody looks at my calendar, it's all real estate all day long, and that in a way that's my calendar. But I think it's particularly critical if you're switching from something else into real estate, they're going to be like, really? Are you doing this to save taxes? Or are you actually being real estate? So, and that's not, I mean, I don't blame them for that.
Mhm. That's true. Yeah, for sure.
Yeah.
It's all about like, do you have other work that you're doing? What are you doing? All those things. Yeah.
Yeah. Very cool. All right. So you have coined something, a term like the 100, what is it? The 100.
The Great American Tax Treasure Hunt. That is
Okay.
what we do whenever you come on. We're looking at all the strategies that you should have taken, that you didn't, right? And when I talk about strategies, so we break our strategies down into personal strategies, business strategies, and real estate strategies. Where our personal strategies are things like the Augusta Rule and pay your kids and your SEP and all those things, right? Your business strategies are what we're really honing in on the Great American Tax Treasure Hunt. Those are things like Do you qualify for WOTC? Do you qualify for empowerment zones, OZ funds, R&D credit? All those things that really get missed 99% of the time because no one's making sure that you have determined if you qualify. And your accountant is not in that space, so they just avoid it. And what do I mean by that? Well, a lot of those strategies, the 100 strategies, take someone that is a specialist in that space. So they take a lawyer or they take an engineer. I'm sure y'all know about cost segregation, right? So cost segregation is one of those where your accountant's not just doing your cost segregation. Usually that you have to have a cost segregation report and it's done by a third party. So all these strategies that I'm talking about are usually done by a third party, and then your accountant comes in, wraps strategy around what that third party gives them, and then puts it to your return. And so those are the things that are getting missed more often than anything else. They're not deductions. They're more like strategies that the software doesn't ask you a question on. And if you don't know that you qualify and your accountant doesn't know you qualify, it just gets missed on
So
the.
let's take a couple of examples of that. What was the thing? What was that zone that you mentioned earlier?
Yeah, so there's opportunity zones, big
Okay,
for
over
real
there.
estate.
Yes.
So if you're doing business in an opportunity zone, you can get a special tax strategy, special tax credits, tax um, where you don't have to pay taxes on those zones. And they change. I think now they're changing like every 2 years or 4 years, they're going to add more zones. So if you get nothing else from this podcast, number one is to keep, your documentation. Number two is to know your zones, know where your opportunity zones are, know where your empowerment zones are in every
Okay.
state that you're
So
doing business
empowerment
in.
zone. I was aware of opportunity zones, and again, for everyone's benefit, opportunity zone is like think Trump under 2017 or something like that put together a map, or had somebody put together a map of like certain areas in every all around the country, like in every city, as a and some of them are really strange, but where if you buy a piece of land or develop something on it, or you buy a building and you redevelop it, or there's certain rules around it, and you hold it for a certain time period, then you don't pay capital gains tax, for example. You
Correct.
don't, and so there are a lot of people jumped right on that. When I'm saying it's strange, it's like because I live in the Phoenix Scottsdale area. There's Old Town Scottsdale, which is one of the most cutest kind of place in on earth. It's like this Western town and things like that. Almost entire Old Town Scottsdale is an opportunity zone. So
Hmm.
it's like it's high rent, high developed, really high tourist kind of area. Somehow it got into opportunity zone. So if you can find something, an old building that's not historic, in developing there, you're in the top number one class A kind of location to do something, versus a lot of the opportunity zones, they're more like in class C areas where that they want to see redeveloped, and they want to see like areas that's gotten down, they want them to be coming back up and things like that. But what is an empowerment zone?
So empowerment zones, same kind of thing. They're just more specific to different on the map. So
Okay.
they're more probably lower class, but I say that, but like you said, you saw one on the opportunity zones that are not. I mean, we have one here that's like a college town that's really a nice area. It has higher rent than anywhere else. Like, I don't know how it's an opportunity zone. I think that it's really political. So
Yeah.
you just need to check out your opportunity zones and your empowerment zones. So empowerment zones just have a better tax benefit.
Okay, interesting. I have to look into those. I see. So now, so what are some of these? Even if somebody is, let's say, is not yet in real estate or runs a normal business, or just like some of these things that are kind of almost like more universally applicable that don't necessarily rely on you owning real estate. What are some of those that are mostly overlooked? Like what that you
So
see most often overlooked?
yeah, so okay. First of all, if you're not in business or in real estate, it's really hard to do tax strategy, period.
Yeah.
Usually, for high income earners, I'm going to tell you to do something in like an off market investment that a registered investment advisor has. They will come with tax benefits, but there's not, you're not in business yet. Because let's be real, if you are going to save money on taxes, you've got to do something. Either have to have a business, you have to have real estate, or you have to be in some kind of a registered investment that will produce tax incentives. All right. So what are
So
the biggest
assuming
things?
somebody is in that, so assuming somebody has that, has a business, smaller business, mid-sized business, or whichever
So what
shape
are
or
the
form.
biggest things I see getting missed? So number one, and this isn't even a tax strategy, the biggest thing I see getting missed, period, is when people start their business or they go into real estate and they start using things that they already owned personally in business, they don't ever deduct them.
Hmm.
So I know for us, like we went into real estate, we already had like tools, we had trailers, we had lawnmowers, we had all this crap that we already owned personally. And if I wouldn't have been an accountant, I wouldn't have known I could deduct all that in business, even though I bought that a long time ago, right? I
Yeah.
turned it into business use whenever I became, but got into real estate. So that's the number one thing I see people miss across the board. That's not even a strategy. So let's talk about personal strategies. So usually, whenever you have a business, the first things, the low hanging fruit, are personal strategies, which are things like hiring your kids. Okay, you're in real estate. Your kids could be doing anything in real estate. They could be, mowing. They could be, swinging the hammer. They could be doing any of those things if you're doing those things. They could also be doing marketing. They could be doing mailers, however you're getting those people. But hiring your kids and incentivizing them to work and being able to move that income that's already family income over to your child, who can then pay for their school, or can pay for their clothes, or for their, vacation, or whatever that is. That one is, pretty easy. Also, the Augusta Rule, where you can rent your home out for 14 days a year. It's a
So
tax
before we go
deductible
that, so it's
business.
just hiring your kids. What do you recommend you pay the kids? Just under where
Yeah,
the
so
where the income tax hits?
I don't suggest paying them over like 14.5. Um, But again, you don't have to pay them. You could pay them 5,000. You could pay them
Yeah.
8,000. I like to max out their Roth IRA, so that they can then go invest in real estate or whatever they want to do.
So
Because
you just combine something else. So the first thing is put your kids on your payroll for like minor roles and make sure you document that they actually do it.
yeah,
Right. So the second thing is, so then you pay them a little bit. We did that since my daughter is 3 years old. She's been on our payroll, or 5 years old or something like that, when she started helping us with mailers and with things and little errands and things like that that she could do as a 5 year old, and as the modeling kind of thing, and be on pictures and in marketing and stuff like that. But then
then
the
you should be
immediately
putting her
other,
money into a Roth IRA if you're
yeah,
not
the
using it.
immediate, the additional set of things, like don't just pay them and have the money sit in a checking account. Open a Roth IRA for them where they put after tax money in, but then it grows tax free afterwards, right? So
Yes.
that's a step that most people definitely forget, because I know a lot of people who pay their kids, but nobody has them set up with an IRA.
Yeah, because you can always take what you put into the IRA without penalty. So you don't have to, like, they don't have to go to college. Like if you put it into a 529 account or something like that, they have to, follow the rules of the government. Or if you put it into a traditional IRA, they can't take it out till retirement. With a Roth, you can take out what you put in, you just can't take out um the interest and the dividends
Mhm.
and the gain on it, right? Until they retire. But that leaves you open for a lot of moves they can make, and not pay any taxes on.
Yeah,
So
so have them, even if you do as simple as put in a Roth IRA, take that money and invest it in an index fund. If you don't want to do anything, if you don't want to go down the route of like a self-directed IRA, and now they go with checkbook control and all this kind of stuff that exists, where they can now go into place their own private investments. Even if you just take the money and put it into a good index fund from the time that they're little on, I mean, that can grow a lot. And if for college now they need the money, you can take the principal all back out after 5 years, and that's really good. I bet that 90% of the people who hire their kids don't do that.
yeah,
Yeah,
that's a
absolutely.
good
Yeah,
strategy.
great idea. Going on then, you mentioned something else, I think, like the Augusta Rule. Let's talk
Yeah,
about that.
so Augusta, you can rent your home to yourself for 14 days a year. It's a tax deduction to the business, tax-free income to you. Again, and if you're wondering, like, how do I keep all these records? How do we, determine how much we should rent our home for, or whatever? We do all of this in-house for our clients, and it's done for you, right? So like you don't have to go and get some calculations on like how much you should rent your home for. We do all of that. Anyways, so if your house would rent for $500 a night on like an Airbnb site or something like that, which you're not renting it on Airbnb, just saying like you got to come up with your with the amount. That's what we use is Airbnb. We use hotels, and we do a three-factor approach to coming up with your value. But $500 a night, 14 days a year, that's $7,000. That's a tax section to the business, tax-free income to you.
Yeah.
So
And
again,
the
just
Augusta Rule essentially says that you can rent your own house back to your company or to yourself or to
yeah,
your company for up to 2 weeks a year. No, you can rent it out. That technically not to yourself. Like you can, well, you can, but you technically it says you can rent it out for up to 2 weeks and not pay taxes on the income.
right.
But
Everybody
any,
can do that. Anybody can do that.
yeah, anyone can do it. That's called Augusta because I think it comes from Augusta, Georgia, when
Yep.
they have like the big open and for 2 weeks people rent out their place and because everyone and their brother comes to Augusta and there's not enough hotels, so they rent their place for 2 weeks and then the whatever the all the golf players they move on to the next place, they get back into the house, and that money from those 2 weeks they get to keep. Now the question, and that is actually a conversation I had with my CPA the other day, is like, as like, are we using the Augusta rule? And he's like, and he had to admit that we had not. So I was like, okay, why are we not using the Augusta rule? And he's like, his thing is like, because you can't just rent it to yourself. You have to have a reason to rent it.
Yes.
How do you overcome that? And now that is an easy thing to me. We have a nice representative house, and we have sometimes parties and things like that. And I can that could be like I do two parties for 2 days preparation and everything. That's a 2 day rental, and I do that 6 times a year, and I got it covered, and that's easy to do. And starting now, we're doing that, but for the last I don't know how many years we missed out on it. But how would just somebody normal that just as a normal house, how would they like document that they actually had a reason to rent it out?
So I have a lot of ideas on this on my Instagram and TikTok. I
Okay.
do some trainings, but let me just go over a few. So one is, you're wanting to put your kids in advertising. Take pictures of your kids. Do a photo shoot at your house. Do a photo shoot for your brand. Have your employees come over, do meetings. Have your clients come over, do meetings. Like it doesn't have to be. I mean, even if the house is not like something you're gonna plan a like party at or something like that, that's okay. I'm assuming you have like boardroom meetings or something like that. Also, you cannot use your home office, right? So it has to be outside of your home office. So some of the ideas I've had is like recording a podcast, like if you're uh, do a do 14 days like in the kitchen or and do it around the kitchen, right? Like do your marketing and you need a kitchen for it. Like I've had people that are in the cooking space or something, right? Or maybe you want to do 14 days of Christmas or 12 days of Christmas by the Christmas tree and you need to use your living room. Like make it where there's a purpose for having to have it outside of your home office. All right.
Okay.
So podcasts are video podcasts are good. Any kind of thing that you're going to put on like Facebook and put $5 of ad money behind it. Um, Anything like that. I mean, we use ours mainly for when our employees come over. That's the easiest thing, but a lot of you don't have employees, so you have to be more creative. I would use ChatGPT and say, hey, I'm trying to get my 14 days of rental. This is what I do. Give me ideas. And you can just keep telling ChatGPT to give you more and more ideas. And there will be something that comes across that you can do.
Yeah, I mean, just you mentioning this, I need to go back to my CPA because, for example, we're doing for our one of our businesses, we're doing a week-long Zoom-based master classes, and where we explain our land flipping works and our concept works, and I do them always from the living room. So there's weeks and weeks and weeks that I use our living room for that we should rent our living room or our house to our business for that. Obviously, not more than the 2 weeks,
you
but two
just
weeks of
have
that can
to
easily be done.
you
Yeah.
just have to make sure there's a reason that you need to use your living room. That's why I say like because if you're doing it based on a Christmas special, there's the Christmas tree, right? Like some reason why you can't do it in your home.
Ah, okay. Okay. That's good. That's good additional information.
Yeah.
Yes. Wonderful. We have done the Christmas in Christmas. Last year we've done 8 days of Christmas. There we go.
Yeah, yeah.
That thing. And with a Christmas theme and their living room in the background and so on. So very good. See, there we go. There, I love this. Great. So you said that you do this for your clients. So what do you do for your clients?
So when you take these deductions, you have to have an invoice for each day. You have to have a contract. You have to have the rate that your house will rent for. You have to have all this list of stuff that the IRS is going to want. Remember, the IRS is a company of documentation. So they want to know that you have all of these pieces of paper for every single day that you do this. Or if you pay your kids, they want to make sure that you have a work log, that you have a contract with your kids, that you have all these things to make sure that you can deduct this legally. And so we will do all of that for our clients. We make sure they have all the documentation, and we give them a binder at the end of the year. We give them a binder up front, with their tax strategy plan and all that stuff. But then we give them a binder at the end of the year with all the documentation that they need. And then obviously we have audit support as well. So you're not going to need that documentation. We'll need it. But just so you have it and hey, if I get audited, I have all this stuff. Like I'm good to go. So that's what we do. We send out the first binder that we have, like sets everything up, right? So like your family management company, your Augusta plan, your accountable plan, all those things. And then at the end, we give you all the documentation that goes with it. And then with the 100, the Great American Tax Treasure Hunt, we review you for all the strategies that we have available. And we figure out like, okay, you qualify for this or you qualify for that. And then we give you that report, and then we say, okay, this is how you're going to implement this, and we'll connect you with, if that is an outside person, like, a lot of y'all need cost segregations. We do cost segregations here. We're one of the best as far as economical priced, and we wrap tax strategy around it. So like, we do every strategy that is out there, we do it. And I think that's what sets us apart.
All right. That's very cool. Where are you based?
I am based in Arkansas. We have a team all around the country. I think we have team members in 20 states, including Hawaii. We're all the way in Hawaii now. So
All right.
pretty awesome.
Which island?
I don't know.
Probably
Maui
Honolulu.
or something?
Maui,
I don't know which
Maui?
one.
Okay. Very good. Well, Maui, there's a lot of people that need tax strategy there because even the doghouse is worth $1 million over there. So,
We have a lot of clients. I'm always so intrigued that we have clients and now an employee in Hawaii. Like, who would have thought we would have gotten that far? That's pretty awesome. So I always mention Hawaii because we do have a lot of clients there
hey,
too.
Hawaii is one of the highest tax states in the country, so I would assume that that there's a particular incentive to find a lot of loopholes if you because otherwise you get eaten up by taxes. I think after California, I think it's the highest tax state for all kinds of stuff, and they're getting worse and worse and worse right now over there. So yeah, we have a little place over there that we go on an ongoing basis. So we talk to a lot of real estate people there, and it's insanity what's going on. But that's a different subject. So with that said, so great. So now, who benefits most from your services? Somebody who wants to start the business, somebody's in the middle of it, somebody's already advanced. Like, who do you think is like is the perfect person that benefits from you?
So we have an option for everyone. And that's because we are, we're very well diverse. So we have people that come on and they don't have anything, right? They just have a W-2, and we start teaching them real estate acquisitions, business acquisitions, because those are both great tax strategies. Then we have a package if you're like 0 to 30,000 after expenses, and then we have a package if you're 40,000 and up. And so we have something for everyone because
Is that monthly income or monthly revenue, or is that
nope,
overall?
that's annual
Annual.
income.
Okay.
So, yep, we have something for everyone. We have, again, there's so much to learn, and also we're about paying less tax, but also growing your wealth, right? And there's so many things that you can do. I'm always learning new strategies, and as I'm moving up, will come in and I'll be like, I've known about this and I've seen this, but private foundations, that's something that's getting a lot of traction lately. And I think that that's a really cool strategy, whether you're just a W-2 earner or you have a business or you have several businesses, because what we teach is moving your wealth from generation to generation. And a private foundation actually moves your thought process from generation to generation. So if you look at like the largest families in the country, they all have private foundations. And the reason they have those is not for charitable work. It's mostly for moving their income from one generation to the other and teaching what they've taught those kids in those generations from one generation to the other. So that's a cool
Let's talk about
strategy.
that.
Yeah, go ahead.
Let's talk about that for a second. The private foundation. I've been always intrigued for that, but there's one thing that never makes sense to me. And that is, now it's not that it doesn't make sense to me, but the understanding is that, my understanding, correct me if I'm wrong, is that if you have a private foundation, you have to give away 5% of the asset value or something of that foundation every year to charity, because that's kind of like the trade-off. Like you either pay taxes on it or you have it. Now, is it 5% of the income or is it 5% of the asset value?
It's 5% of the income, but also remember you get 1.9% on interest and dividends.
You get what?
So you only have to pay 1.9% taxes on interest and dividends.
Oh, okay. So you're saving. So you've taken $1 million, let's say, pick an easy number. Probably some people put much more than that, but take $1 million into a private foundation. Now you have to, if that $1 million makes nothing, you don't have to give anything to charity that year. Now, of course, you want to give to charity. I think everyone should give it to charity, but just as a mathematical example right now, if that thing doesn't make anything, you don't have to give anything, or do you have to still give 5%?
You're on the 5% is your it's the fair market value of your non-charitable use assets.
Okay, so it's the fair of the non-charitable use assets. So of the assets, therefore, so you would have to donate $50,000. So ideally, this only makes sense if you produce more than $50,000. So because then you preserve it, or if you have that $1 million invested in something and it makes your 10%, and you have to pay higher taxes. Now you only pay 1.9% taxes in this scenario, and instead you just rather give to charity. So it makes sense for anyone that wants to give to charity anyway. That's for sure.
I was trying to think through, because obviously this is a new strategy for me, so I haven't gone all the way down the rabbit hole. But we give a lot to charity anyway, so like we're giving 10% anyway. So
then it makes perfect sense.
Actually, yeah. So this way you're moving 30% of your income over, and then you're giving away non-charitable use assets. So I guess it really depends on in my situation, mine's actual charitable use, so I don't have to do the 5%. But if you're not using it for that purpose, then that's where the 5% gets you. So for me, I haven't really worried about that rule because we're more focused
on money is charitable use,
actually using it for that purpose. But I would say, and it says 5% of the excess of the fair market value of all assets of the foundation. So I'll have to look at that more, but it's a pretty cool strategy that once
the excess, the excess of the fair market. So that you put $1 million in, and then if that grows, it's the excess. So you're only giving off it sounds like you're only giving off that. But bottom line is, we don't need to go into much detail. Bottom line is, for those listening, you want to educate yourself about these kind of things, because there's also a lot of misinformation out there. So for example, I always thought, and that's why I haven't done it, that if I put $1 million in there, that every year I have to give 50,000. And if for some reason we hit a bad year, I keep giving 50,000, it depletes my $1 million. And I want to be in a position of giving abundantly, but giving ideally of the profit. So if I have a foundational money and now that makes $100,000, I'm happy to give $50,000 of the $100,000 and give 50% of the profits. but I never did it because I always assumed it was the other way around. But it sounds like there's a distinction between charitable assets, non-charitable assets, excess. So this is why this is important. Don't just listen to anything out there. Just go. If you have the ability, if you're giving to charity anyway, if you have the ability if you want to create something that moves the funds over to the next generation and the next generation, then at least look into it, because with somebody that's look into it, because once it is properly established, and you know exactly the rules, you can make an intelligent decision on whether or not that is something for you, right?
Right. Yep.
Yeah, love
But
that. Love that.
also just always be learning. Like I've
Yeah,
been doing tax strategy since I was 14. Before I even knew what tax strategy was, I've been doing it. And people are like, I'd go in and I would do something. They're like, where'd you learn that? And I'm like, it's just common sense because I've been reading the tax code. But even still, at this age, like I'm still learning new things because
sure.
there's always new strategies that are coming up or that are popping up that are like private foundations are black and white in the code. This is not something that's a gray strategy. That's not what
No.
this is. It's black and white. But once you get to certain income levels, now you can start doing strategies that are kind of outside the box. So again, I would say real estate strategy, acquisition strategy, those two alone will get you to zero. If you are trying to find a shortcut to zero taxes, the shortcut is Airbnb or business acquisitions and being able to take the Section 179 on the business acquisition on furniture, fixture, and equipment. Both of those will get you to zero the first,
Yeah.
the first year, the second year. Then you can come back in and you can put in those personal strategies, the business strategies, the real estate strategies, and get to zero over and over and over again.
And then after that, you go look into these personal foundations. I was just personally interested in it, and you you already just the little bit we talked about it made it clear to me that I'm uninformed about it, and that I need to dig deeper on that. Very cool. Now, great. So now, how does somebody get a hold of you? Because I understand there's last thing. You guys don't actually do all the tax returns, right? Or you do those too?
So we do. You
Okay.
get a credit over to Stable, which is our firm that does all of that. So
Oh, okay, great.
it's
That's even
yeah,
better.
we do have that. We didn't for a couple of years. We actually, when I left the IRS, we did it, and then people were like, "Well, I want to keep my accountant." So you can keep your accountant. We give you a credit over there, so you can use them, which is my company as well. You can use us if you want to, but you don't have to. You can keep your own accountant. So we do all the paperwork. We do, everything, and then your accountant can put it on your return, or we can put it on your return. So
Yeah, so you
it's
basically
only up to you.
provide, if somebody wants to keep their own accountant, you basically provide them with a clear list of all the items that they qualify for, so that they can give to their accountant, so the accountant can go make sure that everything is in the return. But ideally, if they want to work with you, they can also work with you.
Yeah, and if they
Very
keep their
cool.
own accountant, we actually do the work for their accountant. So they don't have to do anything. They just put it on the return. We give them a journal entry they can input within 4 minutes on the return. So very easy for the accountant to put it in.
Well, even better. That's like you're taking care of everything here. So how does our audience get a hold of you?
So our company is called Tax Strategist of America. You can go to taxstrategistofamerica.com. Also, I think you have
Tax
a link
strategist, is it plural or singular? Tax
yeah,
strategist
it
or
has an S on it.
okay,
Yep.
tax strategists
Yes.
of America.com.
Yes.
Okay.
And
We're
then I
obviously
think
going to
you
put it in the
have,
show notes, but
yeah, and you have a link that you can use for the show notes as well.
wonderful.
And just click on to come to a webinar. You can also find me at Carlotta Thompson on TikTok or Instagram, Facebook, and you'll see all of my tax strategy videos. And I look forward to y'all following along and learning more about tax strategy.
Wonderful. Tax strategists of America.com, or CarlottaThompson.com, or not .com, Carlotta
Yeah, you
Thompson.
can go to carlottathompson.com too.
.com too, but Carlotta Thompson on TikTok, on the different social media platforms. Go there, check it out. Guys, you got to have a good strategist on hand. I've been working with my CPA on tax strategy for decades. It has saved me probably, no, I'm not kidding, millions of dollars in taxes over the years. And it is absolutely crucial to know what the tax code does, to know how you can protect yourself, to know you can get, like, you're not cheating the system, just to be very, very clear. The system is very clearly written, black and white. The thing is, 99% of people just don't use the tax code to the fullest extent that the law allows you to use it. So it's like when you give you a coupon in the store and say, like, it's a 10% coupon, are you going to say, like, you know what? I don't really think I should use it. No, you got to use the coupon. So here's the thing. Carlotta and her company offers you a coupon catalog that they can go through and see which one you qualify for so that you can actually pay the minimum amount of taxes. And I love that it's the path to zero. Because ideally, if you do this all right, you can actually literally reduce your taxes legally to zero. And who doesn't want to do that? I certainly do. So with that said, thank you very much for being on the show.
Thank you.
All right. And with that said, that's a wrap, guys. As always, give us that 5-star review, share it with your friends, particularly this episode, because everyone that has a business needs to know about tax write-offs. It needs to know about tax strategy. So go share it, spread the word. And with that said, thank you very much. See you in the next episode. Bye-bye.